Howdy, Jacob here. Today we're looking at ticker symbol DIOD in the semiconductor and semiconductor equipment industry. 2.8 billion market cap on 2.6 billion enterprise value, so a lot more net cash on hand than debt. Incorporated in 1959 out of Texas. Growth is pretty impressive, almost doubling from 2014 to 2022, but we did see a big decline in demand and revenue in 2023. Their gross margins haven't improved. Their operating margins have also improved, which is great. And return on invested capital recently, the last 3 years, double digits. So mostly looking good outside of the most recent year, revenue going down. Their R&D spend is pretty solid, not quite 10% of revenue, but you're looking at maybe 6, 7, 8%. So not bad there. Not bad investing in money today, taking money away from today to hopefully get more in the future. That's fine as long as it's good investments in research and development. About 325 million cash-like products, 45 million short-term debt, 17 million long-term debt. Loving this balance sheet. They have a lot more cash on hand than interest-bearing debt, so we're not concerned about them going under as long as they make money. If you have more cash on hand than debt and you make money, positive free cash flow, it's nearly impossible to go into debt. I can't think of a way, but I'm sure there is. But either way, big growth in cash from operations. However, their CapEx is also going up due to reinvestments and acquisitions. And a lot of their money is going to debt reduction. So their debt is now pretty much out of the way. And it looks like the last 3 years, over 50% of capital allocation has been going to debt reduction. So what are they going to do with that? Hopefully make acquisitions, reinvest, and get some large rates of return on revenue and make the company more efficient, increase those margins. So I'm ready to make some assumptions here on the revenue growth side. Pending they do make a lot of acquisitions and reinvestments with capital allocation, they're probably able to grow 7% a year. I think semiconductor and equipment industry has a lot of competition, but I do think that their growth will be long-standing. I'll go with 11 and 9%, given what I'm seeing in margins here. I don't like that free cash flow is a little lower, so that's why I dampened the earnings, even though their last 3 years they've been higher. And then a share change of 28 million. They don't buy back any shares. Stock-based compensation is 1%. So let's say they increase shares 1% a year. This is saying that with my assumptions, it needs to fall 56% before you get the return we look for here. I think it's a fine business. I just want to get it at a more attractive price, given that semiconductor industry is very competitive. I don't think they have any sort of moat or dominance in this industry like some other businesses, but I do think that there still is a lot of growth. And I know the semiconductor industry itself is growing like crazy. So if they're able to put their foot in and grow with the pie, I think there's going to be a lot of dominance. But for me right now, just not at the price that's extraordinarily attractive. Hope you enjoy the video. Thanks.